Hello, I'm Noel Lim on ASEAN Speaks by Maybank. We look at a slew of economic data in the region as well as earnings of Singapore banks and tourism stocks in Thailand. Chua Hak, co-head of macro, moderates the call with our analysts.
Hey, hi, good morning, 7 November. Just a recap of the markets last week. Generally, the US markets were sharply lower as the Fed hiked the Fed funds rate by 75 basis points, as expected. But Powell did warn that the Fed still have some ways to go, and the ultimate level of US interest rates is likely higher than the previously estimated dot plots. The S&P fell 3.4% a week, while the Nasdaq fell 5.7%. Asian markets, in contrast, were boosted by hopes and perhaps unsubstantiated news that China will exit soon from its zero-COVID strategy. The Hang Seng Index rose by almost 9% for the week, Shanghai by more than 5%, and the Singapore Straits Times by more than 2%. But a Bloomberg article over the weekend, however, reported that health officials vowed to unswervingly stick to the zero-COVID policy, dampening hopes that Beijing was working towards easing restrictions. So there could be a sharp pullback in China markets today. The Bank of England also increased the policy rate by 75 bips to 3%, but the guidance was not as hawkish as the Fed. The Bank of England guided that rates will not need to rise much further to bring down inflation, forecasting that the UK is facing its longest recession in 100 years that could last throughout 2023 and the first half of 2024, as high energy prices and tighter financial conditions weigh on spending. The British pound fell 2% last week on the BOE guidance and recession fears. The US released a key job data on Friday, the non-farm payrolls for October. The US economy added 261,000 jobs. In October, that's far higher than the economists' consensus expectations of just about 200K. The unemployment rate ticked up to 3.7%, just slightly above its pre-pandemic low. So I guess the solid US labor market is a bit of a sore point and challenge for the Fed, as acute worker shortages are still driving up wages and stoking up inflation. Jay Powell earlier in the week had described the job market as overheated. Some key data out this week includes the US CPI October data out on Thursday, which may influence the Fed's December rate hike, of which markets are currently pricing in a lower 50 basis point rate hike. But of course, a hot inflation number could also erase all hopes for some kind of Fed pivot anytime soon. The US will be holding the 2022 midterm elections, in which control of the Senate and House of Reps will be at stake. The Democrats' majority in Congress, we call, is razor thin. So checking on just the two largest betting sites, including Predict It, just showing the Republicans actually winning and taking control of both the House and the Senate. The well-known 538 site is also predicting a dead heat for the Senate, with the Republicans likely to win with a 55% probability. And for the House, the Republicans are very much favored to win with a high 84% probability. So America may be entering a lame duck presidency and a divided Congress for the remaining 2 years based on these predictions. Some of the major companies' earnings reporting this week include Disney, Neo, SoftBank, SMIC, NAB, Nintendo, and Nissan. Today, we have Suhaimi on a Fed rate hike and a Bank of Malaysia rate hike. Juway and Zamros on inflation in Indonesia versus the Philippines. Juway on a sharp turnaround in Thailand's current account to a surplus. And will that last? Brian on the divergent fortunes of Cambodia versus that of Laos and Myanmar. Andi on his latest thematic on the Fed and US dollar. Thilan on his views of the latest 3Q Singapore Bank results. And Yuwanee on her downgrade of the Thai tourism stocks. So let's kick off first with Suhaimi. The Fed hiked rates by 75 bips last week to a target range of 3.75% to 4%. Which brings the Fed funds rate to the highest since 2008. And that's the fourth consecutive 75 bips rate increase. What is the Fed signaling for the pace and direction of monetary policy from here on? And where and when do you think the terminal Fed funds rate will end up at?
Good morning, Habin. The latest FOMC statement suggests Fed still need to raise interest rates further to bring inflation down to the 2% target, but future rate hikes will incorporate the effect of the cumulative 375 basis point hikes to date. In addition, at the post-FOMC meeting press conference, the Fed's chair stated that the ultimate level of interest rates will be higher than previously expected, implying the terminal Fed fund rate will be above the median of 4.6% as per September FOMC's dot plot or guidance. With that, we expect US Fed fund rates to increase further at the 13-14 December FOMC, but by a slower pace of 50 basis points to end this year at 4.25 to 4.5% target range, and now foresee the benchmark rate reaching a peak of 5% to 5.25% by spring next year, and likely stay there for the rest of 2023.
Bank Negara Malaysia raised the policy rate by 25 bips to 2.75% last week. That was the fourth rate hike. What is Bank Negara signaling in terms of future rate hikes, and where do you see the OPR going by the end of this year, next year?
From the latest monetary policy statement, BNM reiterated that after last week's fourth successive rounds of 25 basis point hike, which is justified by economic indicators pointing to stronger third quarter GDP growth, a record high core inflation of 4% as of September, and the acceleration in wages and salaries, the OPR at 2.75% now is still accommodative. BNM also said it is not on any preset course, which means OPR hikes remain essentially data dependent, as well as measured and gradual, so that monetary policy stance can be balanced between supporting growth and keeping especially demand-driven inflation in check. Therefore, at this juncture, we maintain our view of OPR peaking at 3% by the next MPC meeting scheduled on 18-19 January 2023.
Okay, thanks, Suhaimi. Let's move on to Indonesia versus Philippines inflation, which seems to be going in opposite directions. So Jue, I guess why is inflation so much lower than expected in Indonesia?
Good morning, everyone. So Indonesia's headline inflation came in lower than expectations for October at 5.7%. That's an moderation from the 6% in September. Really, the main reason was because of the easing of food prices, which fell to the lowest level in 6 months, and that helped to cushion the surge in transport costs following the 30% fuel price hike on the 3rd of September. Food inflation came in at 0.8%. And volatile categories, including red chili and pepper, have fallen quite steeply, while prices of other food items such as chicken, beef, and eggs have also softened. Core inflation came in at 3.3%, slightly faster than 3.2% in September. But the cost passed through to consumers following the fuel price hike has been smaller than expected. This was also a point highlighted by the DI governor in the last monetary policy meeting. And given the lower than expected inflation, we have cut our inflation forecast for 2022 to 4.3% and 2023 to 4.6%. This is also in line with DI's guidance that inflation will likely peak towards the end of 2022.
Zamros, the opposite seems to be happening in the Philippines. Why is inflation much higher than expected?
Hi, morning, Harbin. Morning, everyone. Yeah, inflation in Philippines was higher than expected. We were just looking inflation in October to between 7 and 7.2%, but it turns out to be 7.7% year on year. Plus the core inflation, which picked up from 5% in September to 5.9% in October. Two factors we think contributed to the higher than expected inflation for the Philippines in October. First, on the natural disasters, we know that Philippines was hit by Typhoon Kading in September and the tropical cyclone Paing in October. So in aggregate, these two typhoon and tropical cyclone contributed about 6 billion Philippine peso of damage to agriculture. That's contributed to the disruptions in food supply in the Philippines. Secondly, on the reopening of the economy, starting from August, the Philippines already have this face-to-face schooling in stages starting in August, but by November, which is this month, the government expect all schools in Philippines to be having the face-to-face schooling. So that's contributed to the, we think, continued upward pressure on inflation from the domestic demand, hence the higher core inflation for the Philippines.
Thanks, Zamros. Jay, I guess for Thailand's current account, that's surprised by swinging back into a surplus in September, I guess from months of deficits. You're now projecting a small current account surplus in the fourth quarter, a sharp reversal from the 6.6% deficit in the third quarter. So what's driving such a sharp turnaround in the current account? And could this help stabilize the baht and stop the bleeding in the foreign reserves?
Yeah, the current account swung to a small surplus of around $600 million in September. That's the first surplus seen in 6 months. And this is really because the goods trade balance swung to a surplus. And also the deficit in the services balance narrowed. And that was attributed mainly to lower freight costs. We think that the current account may post a small surplus in 4Q. Given easing global oil prices, as Thailand is a net oil importer. Secondly, the larger inflow of tourists for the year-end season, and also thirdly, the continued easing of freight rates. Thailand is on track to surpass its 10 million visitor arrivals target for this year. As of end October, arrivals have been tracking at 7.6 million, and at least 1.5 million visitors a month are expected for the next 2 months. And in particular, flight bookings from India and Malaysia have been leading the return of tourists. In fact, tourists from Malaysia have actually climbed back to pre-pandemic levels as of September. Payments for freight transport used to account for less than 3% of GDP before the pandemic, but has widened to 7.4% of GDP in the first half of this year because of high freight rates. And that accounted for nearly 80% of the services deficit. But given that freight rates have been plunging and are actually nearing pre-pandemic levels, we think that the services deficit will actually narrow quite significantly. And this improvement in the current account balance could help to cushion the baht. But I still see some drag factors for the currency. Interest rate differentials between Thailand and the US stays wide, as the BOT has been among the slowest to hike, with just 50 bips so far. And our FX team is looking at the baht to stay weak at around 38.5 against the USD at year end.
Great. Thanks, Jay. Brian, you released an update on Cambodia, Myanmar, and Laos, highlighting the divergent fortunes. And it seems like Cambodia is holding up relatively better than Myanmar or Laos, but exports are also turning down. So will Cambodia GDP growth hold up and come in within your forecast?
Morning, everyone. So for Cambodia, indeed, goods exports declined 7.7% on a year-ago basis in September, and this was its first drop since August last year, as apparel demand was hit by burgeoning retailer inventories in overseas markets amid surging inflation. GDP growth in the second half will be impacted significantly by the downshift in exports, since exports make up a substantial 65% of GDP or so. But at the same time, tourism has been the silver lining, with foreign visitors in September having reached nearly half of their levels in Jan 2020. And this is actually one of the fastest recoveries in ASEAN. On balance, I think that our GDP growth forecast for this year of 5%, which already stands lower than 2019's growth of around 7% despite last year's really low base. I think that 5% remains achievable given that there is some support going on from the reopening tailwind.
So Brian, it looks like Myanmar and Laos are facing far bigger problems. What are some of the pressure points?
Yeah, so Myanmar and Laos have been impacted by outsized currency depreciation for around 20% and 50% respectively due to low market confidence and policy actions. With raging inflation well into the double digits, surging living costs are quickly eroding household incomes and consumption. Laos will continue to grapple with its external debt as currency depreciation has exacerbated debt servicing costs, and raising money will also be challenging from the financial markets amid tight global financing conditions and credit rating downgrades. In Myanmar, escalating civil conflict has dimmed FDI prospects FX and also has kept foreign tourism away, that preventing the country from benefiting from, I guess, the rebound in regional tourism over the past year.
Thanks, Brian. Andi, in the latest ASEAN thematic, you look more closely at the link between the Fed and the dollar. So I guess from the historical relationship, do you see the US dollar rally stopping and stalling if the Fed moves to smaller incremental increases, but with a higher peak rate? Or will the dollar keep on steaming ahead so long as the Fed keeps hiking?
Morning, Habin. Yes, indeed. I think what Powell has mentioned last week in terms of slowing down the pace, but actually making the terminal rate higher, it has led to some developments on the dollar front. So essentially, it's net positive for dollar so far, and it has weighed on risk sentiments, although price action suggests that further dollar rallies sort of remain somewhat hesitant. In terms of the downshift, when the downshift comes, we think, regardless of that, we are arguably closer to the end of the tightening cycle, in our view. So we've looked at the recent historical data for clues in the piece, and we shared the results on how the dollar behaved towards the end of tightening cycles. So I think somewhat relates to some, in some points to some of the questions that you asked just now. So rate hike cycles since the turn of the millennium have actually mostly been steady affairs, actually. So I just want to point that out first. In other words, rate hikes were mostly done in steady clips of 50 basis points and 25 basis points, and do not really necessitate much of a downsize in rate hikes. But if you look at the 100 calendar days before and after the peak of the past tightening cycles over the past 20 years or so, we found that DXY dollar index seemed to trade sideways within the period of in 2006 and 2018. So the dollar index actually softened the most in 1995 as inflation was managed well and soft landing was achieved thereafter. There's only one episode in 2000 when dollar strengthened into the last rate hike for the cycle before easing off. So this could be due to the fact that core deflator remained elevated even after the last rate hike, and that kept the dollar supported compared to the other observations in 95, 2006, and 2018. So we could see that happen in the current environment where inflation is largely affected by supply side shocks. So we think that dollar could still continue to be supported even after a slight pause in the rate hikes or even a slowdown of the pace and with elevated inflation. So in essence, I think coming to to answer your question, we could see a bit of dollar continuing to be supported, but at a slow pace. But it also depends on how long the pause would be before the eventual sort of fall off from the terminal rate. Habin.
So Andi, for the ASEAN currencies, which currencies in your view now will outperform, which could surprise, whether upside or downside?
Our view is from a trade-weighted perspective, Korean won, Thai baht, ringgit are significantly softer now compared to their recent norms. It's a bit stretched levels of weakness. Could see these currencies recover much more quicker once global sentiments turn. But on the ringgit front, I think the fundamentals on, if you look at it, seems to be okay, but historically, election uncertainty plays a significant role, which could persist for 1 to 2 quarters, typically historically, until the signs of credible policymaking emerges. So you could see possibly not so much on the ringgit front, but we think on Thai baht front, like what could surprise would be on Thai baht, I think in our view, as we prefer Thai baht potentially compared to peso, as it's cheaper in real effective exchange rate terms. And I think with strong and sentiment linkages to China, and if there's any sort of swing out of China and in terms of tourism opening and signs of reopening, that could actually trigger a bout of Thai baht recovery in a significant way. Habin.
Great, thanks, Andy. Thilan, all 3 Singapore banks reported their third quarter earnings results, which largely surprised an upside with big margin expansions in the NIMs. So what are the key takeaways from the third quarter results?
Morning, Habin. Morning, everyone. Yeah, so all 3 banks comfortably beat consensus. And we actually see 3 key takeaways. First, as you said, NIM, the net interest margins saw huge gains, especially for BC, who saw a 54 bip gain, and DBS with a 47 bip gain. There is more room for upside, we think, especially going into the first half of 2023, as central banks are still continuing to hike up. Funding costs will go up, but we are seeing that competition here is rational, and all three have very sticky CASA bases, so that'll help NIM. Second, on a bottom-up basis, asset quality remains pristine, with recoveries and upgrades actually a lot stronger than new NPLs forming. On a top-down perspective, though, there is growing concern with the expectation that something will give way, especially as you start to see Fed fund rates rising to about 5%. We did see higher credit costs as well as more management overlays being put in place by all three. And then finally, capital levels are high, but the appetite for new deals is low, with the exception of maybe OCBC. We think more capital will be returned to shareholders going into fourth quarter as well as next year, with the potential for DBS to do a special dividend for the first time in about 5 years. OCBC, on the other hand, we think could look to bolster their franchise, particularly in Indonesia under the new CEO, Helen Wong.
How would you rank the three local banks now in terms of your preference after the third quarter results?
I think DBS still remains our top pick, particularly given the fact that they have a very low cost funding base. So that will benefit them as overall loan yields continue to rise and drive up NIMs. Followed by UOB, who's got a much larger ASEAN franchise, and that should also provide them with support on their margin side as well as provide some support for growth as well. And then finally OCBC.
Just one more question. DBS price to book seems to be rather high, right, in historical terms, as it 1.7, 1.8 times. So isn't that, and that's your top pick? Is that, how does it rank historically and relative to other banks? And is it justified?
Yeah, so its ROE is 15%, which is higher than it's ever had in its history as well. So I think from from a multiple point of view, I think it's justified given the fact that, you've got a significantly higher ROE profile and a sustainable ROE profile going forward versus what it has done in its past.
Great, thanks, Thilan. Yuwanee, you downgraded the Thai tourism names. Why the downgrade when tourism numbers are starting to accelerate? Or is it all just priced in?
Good morning. We downgraded based on the fairly priced valuation. Despite the recovery, many tourism names are now trading above pre-COVID levels in terms of absolute share prices, despite still loss-making.
So which tourism names are your favorite picks now from here on?
We like Binge because it has underperformed the market due to the concern in Europe. We think the correction of about 30% year to date is overdone, despite the better earnings visibility than its Thai tourism peers. Please be reminded that tourism in Europe recover among the first in the world, and the Thai peers are lacking.
Just the last question. How do you see the tourism recovery panning out here in Thailand for the rest of the year?
The fourth quarter is obviously the high season. And so we think the recovery should be very strong. We think the monthly tourist arrival should be about 1.5 million. That is 45%, 1.5 million a month, and that is 45% of pre-COVID level. And that is pretty much very strong. And going into next year, it could be stronger. We project 55% of pre-COVID, which is about 22 million tourist arrivals for next year.
Great, thanks, Yuwanee.
Thank you.
That's all we have for today. Have a good week ahead.
Speak to your trading rep and check out market insights on the Maybank Trade app, and follow us on Spotify and Apple Podcasts. I'm Noel Lim on ASEAN Speaks by Maybank.